Good morning. David Worrell, your DIY CFO here with an SBA IFR update from the week of August 28th. During the week of August 28th, the SBA put out three new really important clarifications. The first one is on ownership, that people with less than 5% do not need to be called owners. The second one is on people who use subleases within their rental agreement. So if you rent from a landlord and sublease to someone else, or if you sublease from someone else, how you do the calculations of rents. And the third one is what happens if the business pays rent to a related party, such as the owner of the business also owns the building that the business rents. So those three things we're going to go over real quick. Ready? Here we go. Number one, the SBA said that anyone who owns less than 5% no longer needs to be calculated as an owner for the qualifying wages. If you are an owner of the business, we've been saying that you're limited to $20,833 of allowable wage expense, qualified wage expense, during the 24-week period. That now changes if you're less than a 5% owner, 4.999. You may qualify for the entire qualified wages that are the same for any employee. That's $46,105, I think. So at that rate, we just picked up an extra $26,000 of qualified wage expense for each owner who owns less than 5% of the business. So that was pretty big news. The second thing was the discussion of rents and subleases. So what the bottom line is this says that if you rent from someone but then you sublease part of your building to someone else, you can only claim qualified rent expense for the portion of the rent that you pay that's not reimbursed by the person you're subletting to. So if you have a 10,000 square foot office, you pay $10,000 to your landlord, that $10,000 rent, we used to figure that that was a pretty good loophole. You could claim all of that. Well, they wised up to that. You can no longer claim the full $10,000 rent that you pay. If you have a subtenant, you have to offset the $10,000 rent you pay minus the rent that you receive to net out what you are allowed to claim as qualified rent expense. So point number three is also about qualifying rent expenses, but addresses the situation where the owner of the business also owns the building that the business rents, right? So you have a company paying rent to a related party. And in that case, the amount of qualifying rent cannot exceed the amount of qualifying mortgage interest that the company would claim if it owned the building. Or said another way, the amount of qualifying mortgage interest incurred by the owner who does own the building. So anytime there's a rent paid to a related party, it cannot exceed the mortgage interest expense actually paid for the building on that during that period. Now they took this one a little bit further, and they also said if you have a home office, your qualified rent expense that you claim cannot exceed the portions that you claimed on your 2019 income tax. So they're applying a really stringent reasonability standard here, trying to level the playing field and smooth this out between people who own and people who rent, and to alleviate the double dipping that was happening for both the sub-tenancy and the owner-occupied buildings. So just those three things: 5% ownership rule, subletting expenses have to be offset, and mortgage interest is really the measurement of qualified rent when you're paying it to a related party. That's it. Hope that helps. Thanks.